There's a difference between making a good decision and having a bad outcome versus making a bad decision and having a bad outcome. And what we try to do always is make good decisions and educate our investors.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Joining me this week is Michael Episcope of Origin Investments. And I think Michael's actually the most experienced guest I've ever had on the podcast, maybe the most successful guest I've had on the show from a real estate standpoint, if we're going to measure success by assets under management, equity under management, years of experience, track record, etc. And here's some high-level stats. Michael and his team manage $1.5 billion worth of equity. 1.5 billion with a B. That's what we're talking here. Origin Investments is in the top 1% of private real estate North America focused fund managers by Preqin. Just an absolute, 99th percentile business that he's running. 16 years, him and his partners have been running Origin. They have 50 plus full-time employees on staff and 5,000 units. I mean, just an incredible operation that him and his team are running. They've done $2.3 billion worth of transaction, average equity multiple of 2.4x over the last 16 years, which over that time horizon at the size of assets they're buying is incredibly impressive. And in this episode, we mainly focus on higher level concepts, right? Macroeconomic concepts such as picking a market, finding edge. We talk about how Michael views growing a portfolio and actually raising capital. So we talk about when he decides to sell and what they do when they do sell. And we talk about how him and the team at Origin were really one of the first companies to embrace the Jobs Act from like a digital marketing standpoint, and why they have gone all in on content to grow their investor base. And talks about some of the things that they're doing from a tactical standpoint in terms of like the email marketing and the webinar side of their business. But they started digital marketing back in 2014, 2015, which was really early for that type of marketing in terms of growing your investor list. And many syndication companies, syndicators in general, private equity companies haven't really embraced the direct to investor marketing until a few years ago. So they were one of the first companies to embrace that side of the business alongside, the massive crowdfunding platforms like Fundrise and CrowdStreet. And we just spent a lot of this time talking about managing risk. How should you think about risk? How should you think about putting deals together? How does Michael think about risk in their business? So, and then we also talk about some of their failures, right? And Michael shares a line that I think is really, really interesting, and it's really important to keep in mind as a real estate investor or just an investor in general, regardless of what you're investing in, which is good decisions can still lead to bad outcomes. But on the contrary, bad decisions can lead to good outcomes. Just depends on the cycle you're in. And it's important to just manage the decisions that you make. So if you're looking for like tactical in the weeds, how to buy your next deal, this is honestly not going to be the episode for you. But if you're looking to, just listen to somebody who is just incredibly successful, talk about real estate for 30, 40 minutes, this is the episode for you. So really, really happy to bring this episode out to our listener base. It's very rare that you get to hear somebody at this caliber just talk, let alone for me, selfishly being able to interview them. So really, really appreciated our conversation. I think you're going to get a lot out of it. So in closure, if you haven't already, please leave the podcast a rating and review. Helps the show get noticed by more folks. Episodes like this need to reach more people, and people need to gain exposure to just the level of education that I'm trying to bring on a weekly basis here with the Multifamily Wealth Podcast. And ratings and reviews help the show get in front of more folks, which accomplishes that goal. So if you haven't already, would appreciate it if you could do that. But without further ado, let's get to this episode with Michael Episcope. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Joining me this week is an extraordinarily accomplished investor, somebody who is managing over $1 billion in equity, and that's a billion with a B. I can't say we've had too many folks on the show that have hit that level of success in the business. But let's get to his background. Joining us is Michael Episcope. How we doing, man?
I'm great. Thanks for having me on, Axel.
Absolutely. So why don't we start with your journey, and maybe we'll go back as far as you'd like to go. Maybe talk about what you were doing before you got into the real estate business, and how the business has progressed and what you guys are doing today.
Yeah, I won't take you maybe all the way back, but I'll take you back to my first career. I was a commodities trader, and that's really where I made my wealth. I started down at the Chicago Mercantile Exchange when I was 19 years old. Had a great career, made a lot of wealth there. And really what I was looking for in the second part of my career was, how do I protect my wealth? How do I grow my wealth? How do I turn my wealth into passive income? Because when you have a job and you leave it, you're suddenly like, hey, you might be asset rich, but cash poor on the income side. And real estate was something that I was exposed to very young. My grandfather was in real estate. And there's also, I would say, kind of something intuitive about real estate, especially on the multifamily side, maybe because you live in it, you've rented, you see other people doing it. And so I went back and I got a master's in real estate at DePaul, retooled myself, and got together with my current partner in about 06 and 07, right around that period is when we concepted Origin. And really for us, it was almost a need, because if we go back, this is pre-Jobs Act, and if you really wanted to get the full benefit of investing in real estate, there weren't a lot of places to go, because the market was dominated by non-traded high fee REITs. It was also, if you had a lot of money, if you're a big institution, you sort of had your pick of the managers. But for individuals, you could go with the large institutions, but they were more financially engineering at that time and didn't really understand the nuts and bolts. Great sponsors used to charge too high of fees. And so we just set out, we're like, look, we can do better with our own capital. And we just started buying real estate and started doing it with our own capital, instead inviting friends and family, building the platform. We didn't have a grand vision at that time. We just wanted to make money on our money and continue to grow it and put our money in good deals. And the timing was impeccable. It was both in terms of buying great deals and also building a team, because there was a lot of talent on the street at that time. And so it's really grown organically, but I would say, like, from the beginning, it's always been about building an institutional quality platform for the individual. And I say that when I'm talking about that, I mean complete with the team, with about the fees, about the service, about everything that you would expect if you're investing 20, 30, $40 million. And so that's what we think about. And so all of our entire platform has been about going direct to the consumer, building all this stuff, scaling with the individual, the taxable investor. And most people who go into that space, they sell their product through the broker-dealer channel, and they pay high commissions and high fees. And we just didn't want to become what we sort of despised in the beginning, which were those REITs where you're down 15% on the day that you invest in them. And so that has really guided us, and it's helped propel our firm, is that sort of philosophy about just treating people right. And today we have 3,300 investment partners, 1.5 billion in equity under management. We've had a tremendous success, but I think it's not just the alignment and philosophy, but we've also we're a top decile manager. We've outperformed 90% of our competition. Risk management is something that we do very well. It's something I took out of my previous career. My partner, we think about things with both hats on, as the investment manager and the investor. And we're still the largest investors at Origin today, which feels really good. And we've been rewarded for that. So it's been a great journey. 17 years now. It's kind of crazy to think about that. 16 years, something like that. So my second career, I'm almost ready for the gold watch.
Yeah, absolutely. I mean, it's a hell of a run, because, I think that especially today with the advent of the Jobs Act and a lot of people getting into this business, just purely defining this business as raising capital and going out there and buying real estate. There's a lot of people that have started to play in this ocean here. And there's such a wide spectrum of skill sets, of experience, of approaches. And I think more so than ever, at least, this is my opinion, right? I'm not backing this up with any facts, but I think more so than ever, there's an eagerness in the everyday investor to bring some of their capital away from their retirement account of the stock market and place it in some kind of alternative options. And I think it's probably a combination of the internet as well, providing a lot of education around these types of opportunities. But the fact that the track record extends back 17 years obviously is a significant differentiator from all of the noise in this business right now, from all of the people that have gotten into it over the last 3, 5, 7, 10 years. But I do want to talk about the early days, because as you mentioned, you and your partner started Origin, 06, 07, just as the market was about to really make a pretty significant turn, as we're all aware of. What did you face some challenges early in the business growth as it relates to the market adjusting in 08, 09, 2010, 2011? And is there anything that you're looking back to from a market environment standpoint at that time that's drawing any similarity to what we're dealing with today, as we record this in April of 23, and the market being in a position where maybe it's turning a little bit now as well? So I guess that's a two-parter, maybe some of the challenges you faced at that time, and maybe any similarities you're seeing with that time to now and kind of the current market.
Yeah, the biggest challenge we faced in kind of that 07 market was that we were inexperienced. And we, I look back today, and if I could be in 07, understanding and knowing what I know about the business today, it would have been very different. And we were figuring it out. We didn't come from the large institutions. We were investing our own capital. We actually steered clear of a lot of the debacle back then, and it was kind of I don't want to say obvious, but we quickly gravitated towards buying debt from banks, because coming out of the trading world, it's all about getting edge and how do you swim upstream. And I'll never forget, we were like, look, what do we want to do, because everything feels like overpriced, and we didn't know where the market was going, but you could feel the froth at that time. And so we said, look, let's go into the debt world. Maybe we'll provide preferred equity. And we started advertising and doing that. I'll never forget, this guy walks into our office one day, and he starts talking about this, his loan that got sold by the bank to this distressed buyer. And let's just call it a $5 million loan. It got sold for $2 million. And the buyer of the loan wanted to get paid off in 60 days. And he wanted $3.5 million or something like that. And we're like, we want to be where that guy is, right? And so we never ended up doing that, but it really, like, the light bulb went off, and that was a point in time where we started then just networking with all of the distressed sellers, going to all the websites, doing what we could, getting our hands on everything. And I will say it was really good as a learning experience. But the thing about real estate is you have to be able to scale it and also leverage it, right? And leverage is a real estate game. Leverage, as long as you're using it responsibly. And I think at that time, we were paying all cash for these loans. We had great IRR. They were good deals, but we didn't really have a way to build a long-term portfolio. And they certainly weren't assets we want to hold forever, right? I think it made our investors feel really good. It felt really good. We learned a lot in the beginning. But then what we did is we were sort of gravitating towards value add at that time, because you could buy good quality assets well below replacement cost. And we launched our first fund at the end of 2010, beginning of 11. It was a small fund. My partner and I were 40% of that fund. It was only a $20 million fund. But what we did is we started to, cobble together high net worth investors who became very loyal to us and showed them what we could do. And I would say that putting out a $20 million fund is actually much more difficult than putting out a $100 million fund, $150 million fund, because if you want to diversify, deals don't come, that small. But it really, so we did a lot of sidecars, brought in more capital along the way. And it was just like learning as we were going. And we were one of the first groups to really embrace the Jobs Act and marketing. And I will tell you that it wasn't something that was very popular at the time. And certainly even internally, people didn't understand it. But my partner and I were like, look, we want to grow. You want to grow. We're really good at serving this segment of the market. This is what we like. And we're just not making any traction because we were talking to institutions at that time. But again, institutions like pedigrees. And we were like, this is where we're going to go. And it worked. And the whole concept was, look, we're going to meet people by digitally advertising and creating these relationships and build the infrastructure to do this. Because when you have a great product, if you put it in front of more people, you're going to get more customers. That's as simple as that. Yep. And that's when we started to build out the operation. So I would say at the end of 2015, we had about 90 investors at the firm, ultra high net worth family offices. By the end of 17, we had 500. And then the other inflection point was we used to be only a firm with one fund. We had a single value add fund. We had fund 3 going from 2017, 18. So we had all this investor demand, but we didn't have any product on the shelf. And then we launched our open-ended income plus fund. Then we launched our QOZ fund. Then we launched what we call a growth fund. And then we launched, most recently, our credit fund. And so we think about, from the individual investor side, whether you want something on the lower risk end of the spectrum in debt and credit, and you only want yield, or you want something on the higher risk and you want to be in ground up development, high IRRs or high multiples, or somewhere in the middle in our multi-strategy fund, we have all these products. And so that's the thing that really the inflection point over the last 3 or 4 years is demand and products sort of came together. And the market was fantastic too the last few years. But having product on the shelf at all time is really, really important when you're out there seeking demand from investors.
Yeah, absolutely. And that's really, it's, it seems as if you embraced the digital advertising component of building the investor base and growing the investor base a little bit sooner, I think, than maybe the overall marketplace did, right? I think that's something of the last 2-3 years where there's been a more significant focus for many investment managers on the digital advertising side of the client acquisition strategy, investor acquisition strategy, because, the world of social media, the job, it's just it's becoming more mature, right? I think the marketplace is just becoming more mature. If you don't mind sharing, what were some of the tactical things that you were doing at that time to actually digitally advertise and to go from that 90, that investor base of 90 to that 500 and then beyond that?
Yeah, well, we were first mover. And I said this was controversial, both internally and externally. And I'll never forget the team when my partner and I came together and we're like, look, this makes sense. Let's go all in. Because when you're trying to market to 2 different audiences, you just miss the message on both sides. And you have to figure out really who your audience is. And that was the one thing. Once we made that decision and we went all in to service that one investor, things really started to turn around. But I will tell you that internally, I remember these conversations. Well, the market's going to be confused. We're advertising. People are going to think we don't have money. And we were like, well, we don't have money. So what's the difference? But what was cool is as we started to do this, and I'll tell you some of the first things we did is we invested in technology. We brought somebody in from marketing, a head of marketing, a true person. On that side, we brought somebody in on the investor relations side. We actually promoted an analyst on that side. And so we started building the operations around this. And for us, I remember I was just talking to my marketing director the other day about this, but the typical plan for marketing, and this is like marketing 101, you put a third in advertising and a third in PR and a third in content, right? And you know where that's going to get you? It's going to get you last in every one of those places because you can't compete with big groups. We can't compete with Blackstone and these other groups who are on CNBC. So we're like, look, where do we win? And that has been always, how do we win? And content is how we really went all in. We wanted to be thought leaders. We wanted to really educate the investor and the market on how investment management, how real estate works, how looking under the hood, giving them the tools that they can use to actually succeed in this market and get ahead. And we were drawing from the lessons that we had as investors and also providing insight as an investment manager, right? How do you evaluate deals? How do you evaluate managers? What do you look for? And a lot of people are just lost in this business. So, today we have 400 pieces of original content. If you Google any really concept about multifamily, we're usually on the first 1 or 2 pages. So that took a long time, but we decided that's where we can win. And everybody at Origin is a content writer. So we have a piece, Origin Insights, that goes out every 2 weeks. We have a piece called Market Monitor that goes out every 2 weeks. And we have a lot of webinars. So we're constantly trying to stay in front. And honestly, that's still the same today. We do a little bit of paid advertising, but most of what we do is organic, people coming in through that means, and then also through referrals. We get quite a few referrals from our existing investors. And, everybody looks for a magic bullet and there's not one. There's not, oh my God, if you get in the Wall Street Journal, if you get into there, right, they're just going to come in. It's a lot of hard work. and just constantly showing people and proving to them that you are the person they hired. And you have to do that. And, it takes years to earn somebody's trust, but you can lose it in seconds. So it's really important to continue to improve operations and just make sure you're delivering on what you say you are.
Absolutely. No, that's the playbook. I mean, you have to establish credibility in some scalable fashion, right? And do so in a predictable way. And then you have to blend that with some patience, which you guys have clearly done. And that's fantastic. So I have one more question as it relates to the actual business of Origin, and then we can get into some more real estate focused conversation. But trying to think of the best way to ask this, but what do you feel as the CEO of the business, co-CEO of the business, right? In terms of the differences between running it maybe back in the early 2010s when you had raised that $20 million fund and it was you, your partner, and it was, maybe you had some folks on the team at that point, but it's a smaller business relative to where it is now versus running a true institutional scale investment platform. What would you describe as the largest differences between those two types of businesses? And what have you really learned as it relates to operating those two types of businesses?
Well, the biggest thing is the size of the team. I mean, today we have 54 people at Origin. And if we go back to 2010, we had 4 or 5 people and we were doing everything at that time. And this business is all about people. And the real estate itself is pretty simple. And when you apply the same lessons, whatever those are, to small dollars, and you start using those on bigger dollars, you just want to make sure that you don't have strategy drift. And some of the things, I mean, I've always been a student of the game and done a lot of reading and research and understand why other managers fail, why they blow up. And it's usually because deals are complex, they over leverage, they run out of money. And those are sort of the 3 things that they all have in common. So, we try to keep it simple. Things right down the fairway. We're not here to get people rich. Most of our investors are already wealthy. They want the long-term benefits of owning real estate. And our job is to protect and grow their wealth. So we use moderate leverage. We invest in really good projects. We partner with great people. We have, I think internally our operations are as good as anybody, if not better, out there as well. I mean, our investment management team, they just got ranked the number 3 best operator. I forget the exact magazine or publication or something like that, but it was a big coup. And I think that they really do a good job on the ground. And so it's just a constant improvement. I wouldn't say, it's just more complex, right? People, managing people is a full-time job. But what I like about it is I'm more on the strategic level right now. And we have great teams of people who kind of handle all the operation side. And so we've been able to scale the business to a point where, David and I, my partner, we're keeping the ship aligned and setting the vision and the tone, but it's really up to the team to execute with our oversight. And the best thing we can do is just give them clarity at all moments in time. But he and I are both intimately involved in credit committee and making sure that we are the ones putting up the guardrails at credit committee and there. So making sure that interests are aligned. Hope that answers your question.
It does. I asked it in a bit of a clunky way, but I think you touched on it or touched on a couple of points there that are very effective, which is I like that phrase of we're not here to get our investors rich. We're keeping them rich, right? They're already wealthy. They're coming to us in order to gain exposure to real estate in a risk mitigated way with very experienced operators, very experienced team, et cetera. And I think that there's oftentimes an opinion from those who are outside of the operation of these types of businesses. Our business is closer to where you were in the early 2010s. That's kind of the size we're at right now. A couple of people on the team. We're starting to grow and things are starting to really click. And just trying to understand the difference between like what constitutes a platform of that size from one that is growing. And again, you mentioned it, right? It's people. You're executing a very similar strategy, but you're just doing it at a larger scale. And that makes total sense. Now, in terms of talking about your firm's approach on the real estate side, in the research here, I've noticed that something that you would define as a real core competency of yours, and then therefore as an extension of yours to Origin, is the ability to take calculated risks and maybe make bets on some inefficient markets, or to hone in on on markets that aren't necessarily operating in such a way that they should, or maybe it's asset class as well. And I want to dive into that concept. So first, I'd like you to maybe define that in your own words as how you would describe that as an edge. And then I'd like to ask, how do you find the confidence to maybe contrarian's a bit of too overkill of a word to use here, but to make different bets maybe than what the consensus is doing in the marketplace at a given time?
Yeah, and I wouldn't call us a contrarian, Axel. At the height, kind of the top of the pyramid, we're risk managers, and that's what we think about constantly. What kind of assets are we in? First of all, we're in multifamily. That's all we do. What markets are we in? Why are we in those markets? Because job growth and population growth, that is really what is highly correlated to investment performance, right? And those are the markets that are going to come back. We're in low tax states. We're in lifestyle cities. We're in those markets. Who are the people who we hire? What guarantees do we make? Do the funds make, right? All of this goes into our risk management. What kind of debt, variable rate, fixed rate debt. So that's kind of never ending. And I think that's always our full-time job, is to be risk managers for our investment partners and make sure that we're protecting money at all times, and really asking the question, what can go wrong? What happens if? And we spend a lot of time doing that. And I kind of forgot the second part of your question, though.
Yeah, I think it was, centered around, kind of just the conversation around finding inefficient markets. And maybe a better way to ask this is, how do you think about market selection, maybe at a fundamental level? Yeah,
look, at the size that we're dealing with, there's no such thing anymore as inefficient markets. I think if we go back to 2010, 11, 12, right, the markets, there was edge back then, but candidly, you're not finding, like a lot of people talk about, I bought this off market, that off market, right? We can all define off market, but a $70 million Class A multifamily property is not falling off the back of an Apple truck. Let's just be honest, right? So I would say that the real advantage that we have is that we are agile, because we have three strategies under our roof that we can pivot to whatever strategy is working. So we build, right? We do ground up development. We also buy. We have the ability to buy core plus and value add, and we also lend to multifamily. And so when you think about those three strategies, they actually, depending on what part of the cycle you're in, they're all going to be kind of in favor or out of favor. And so, like in the last 3 years, we haven't bought a single deal. We've actually been net sellers. We were net sellers in 2021, 2022, when the markets opened back up, and some of our legacy funds, we sold more than $500 million worth of assets. The last asset that we closed on was in February of 2020. That was not great timing, but the market shut down completely, and we saw the disconnect between replacement costs and where existing assets were trading for. And that gap was at sometimes 40, 50%. So if you could build for $300,000, some of the existing assets were trading for $450,000. So the last 3 years, we've been on a barbell approach. We've been lending and we've been building. And those two things, building now looks like the margins are deteriorating. And so we will stop building at that point, right? We don't have to do anything. And so I see these other fund managers with one mega fund. Hey, all we do is value add 1990s. Well, it's not always in favor. And when we think about how we want to manage our funds and how we want to do things, right, there's always exceptions to the rule, and you're going to find an interesting deal even in bad markets, but you can't build a company on exceptions to the rule. But what we can build it on is this ability to pivot in and out, going up and down the capital structure and then across different strategies. And I think that's something that's benefited us. And we've been pounding the table for the last 2 years about be defensive, be defensive, be defensive. And that has helped us enormously. So even in like our income plus fund, last year was an abysmal year for multifamily. And that fund ended up making over 9% because it was almost all tilted towards credit and ground up development. And so like we've been able to weather the storm. And I think we're in a great position going forward for whatever, comes in 2023 or even 2024 as we see the market continue to kind of deteriorate.
No, that's an incredible answer, because I think oftentimes people try to strike a balance between really deep levels of focus in one strategy or market or asset class or what have you. But oftentimes, maybe you need to shift your focus right outside of that specific sector that you're currently operating in, or that market that you're operating in, or just the strategy that you're employing. And I guess, again, probably a hard question to answer. You have a very well-developed team, right? So there's probably a lot of brains underneath the roof that obviously support all of these different strategies. But when did you really adopt that, that approach as it relates to diversifying from a strategy standpoint within the business? And how did you think about becoming excellent in these other lanes, whether it was development or the lending side?
Yeah, it was really born. Well, two ways. So back in the beginning, we did pretty much everything, and that was the difference. In 2010, money had all the advantage, had all the edge. Capital was scarce and deals were everywhere, and that was the difference. But as we started going through time, we realized that we had to be more operational experts, and so we really gravitated towards multifamily, and then just started specializing in that particular area. And that's how we've grown, this whole time is in multifamily. And it's been, for us, just, I guess the other inflection point, let me go back a second, because Fund 3 is when we really added ground up development, because we saw that value add was becoming priced out. It was becoming too expensive. And then it was in 2019 that we added our Income Plus fund, which had debt, ground up development, and multifamily value add. But even in that, we added value add or ground up development later on. So it's been iterative. And we look at the markets constantly. But if we find ourselves evaluating deals or running a fund and we say, look, we just don't want to invest, or we need this different tool, we've gone out and gotten many amendments for our funds and spoken to 1,000 investors. And they're like, yeah, look, that sounds great, right? Why do we want to add ground up development to the Income Plus fund? Well, here's why. Because we don't want to buy value add at this point in time. We actually think this is a better bet. And it was interesting because when we originally concepted the Income Plus fund, we did not have ground up development in there, because what we were hearing, and this is from our internal team, is, hey, these are risk averse investors. They don't want ground up development. And then when we were finally like, okay, well, let's ask them, right? And this is like 2 years into the fund. There wasn't a peep. In fact, more people were like, why don't we do more ground up development, right? That's a great, so what you think people want, what they actually want, maybe are two different things, but that's how I would answer that. It's been iterative the whole time, but it was that graduation from, many different asset classes into multifamily, and then just looking at the different strategies within that one sector.
Yeah, makes a lot of sense. Now, you mentioned you've been net sellers over the last few years. And obviously the market has done what it's done, and we're all aware of that. And it's been a great time to be a seller the last few years. I mean, we've also been selling a majority of our portfolio while we still look to buy, but we've also been net sellers, right? And I know a lot of folks that are in that boat. What is your decision-making process as it relates to selling an asset? In terms of, do you look at it in some kind of analytical way? Is it a gut feel? Is it, obviously not entirely a gut feel. Or is the reason that you've been selling just as a result of what the market's done, and you feel like this is the time to take some of your chips off the table? And then we can get into, how you actually treat the proceeds from a tax standpoint.
Yeah. So I'm going to answer that question in two ways, because there's kind of, there's the origin that was the buy, fix, and sell origin. And then there's the origin today that's more buy, fix, and hold. So when I talk about the properties that we're selling, those are actually legacy properties from our Fund 3 and Fund 2. And again, it was sort of the fundamentals of the market, looking at them. Is it got, kind of, but you run the math and you do the sales and you kind of look forward. And I've been in this business long enough between my trading career and real estate that you can, you kind of, when you see euphoria, you know what it looks like. But today because all of our investors are taxable, this is a big shift in the last couple of years, that our funds today are more open-ended. And the concept is that we want to be buying really good properties, fixing them up, adding value, creating that cushion of loss, for loss against equity, and then holding them long term. Because, candidly, like when you take real estate and you put it in a private equity model, you're not taking advantage of some of the best reasons to own real estate, which is cash flow, depreciation, the ability to refinance tax-free over and over and over. And we were kind of banging our head against the wall going, every time we would do this, we would generate great IRR and good multiple, but then we would pay taxes, the money would sit around. It's just an inefficient way of investing. So what we've been doing is really educating our investors about, look, you're better off being in an open-ended fund where you're earning 10% annually on all of your money than in a closed-ended fund that is an IRR-based called capital fund where you're investing over 2.5 years. They're building a portfolio and then you're getting your money back. And I've been in those funds, and this is why I think we are in a great position to be able to do these things, because I've been in tons of private equity. I know what I like. I know what I don't like. We have hybrid funds that are sort of closed-ended but open-ended. We've gotten rid of the fund tails, which are so annoying. Anybody who's in private equity, when you're in these deals for 11, 12, 13 years and you have this tiny little stub there, so we've figured out ways to just make our products better and more friendly for the investor.
Yep. You're right. It's interesting because that is the business now, is people, I shouldn't say the business, but that is such a core part of the business is GPs got to hit their promote. What better way to do that than to sell the property? And it's interesting that we can align incentives throughout the process and do our best to align incentives, but it's really hard to get around that misalignment of incentives, which is, it makes more sense to either sell in 1031 and, keep it rolling, or to just continue refinancing. But it's harder for the sponsor to really tap into meaningful compensation, outside of just you've hit some scale and there's some, significant asset management fees or acquisition fees or something along those lines. How do you think about that piece of it? And $1 billion under management, there's certainly some income along the way, I'm sure, but was that ever a challenge as you were growing the business in the earlier days, or did you just take a different mental approach to that whole conversation altogether?
Oh, it was a huge challenge. From day one, my partner and I were supplementing the business, and we knew we were growing something. We never thought about it from that perspective. Again, if our money was in great deals, I used to tell people, look, it was like we were paying 5% management fees and everybody else was paying 1.5%. And that's kind of how we looked at it. We knew we would have the performance fees that would sort of, pay us back. So we were lending the company money, putting more money into it. We did for a while, but we didn't think about it from the standpoint, we want to make a very profitable firm and this and that. And I think that, again, it's one of the advantages we have because we were both wealthy coming into this. And it was really about building a great firm and understanding that, profits are a byproduct of once you get to that point in time. And today we are profitable. We've had tremendous growth. We're at scale. But I remember, it was every month I would talk to our controller and we would be looking at this line graph and you had expenses up here, recurring expenses and recurring revenue, and they just never cross and they used to always just grow together. And I was just like, man, is this ever going to, straighten out the other way? It wasn't at a total loss because the performance fees did make up for some of that. And we used to look at that as sort of, okay, this is how we can justify it. And I don't think we would do it any other way. It's just, we're risk takers and building a company. You've got that J curve. We were probably in it a little bit longer than we wanted to be, but I'm happy with where we are today.
Yeah. And that makes a lot of sense. That's the biggest challenge, I think, for folks that are coming into this without that, without some other prior career or business or something to support them throughout those early years. And you get into a few deals, you got your co-invest in there, but you're looking at 24 months, 36 months until you get to any kind of meaningful capital event. And then people just like to sell, right? Because I think that they're starved. The business is starved. And maybe that's not truly the best decision to make for your investors. So it's an interesting dynamic for sure, without a doubt.
Yeah, and I think the other thing is that you need to develop a track record. And you started talking about this in the beginning, but it's really, really hard to break into this business and grow something large because by the time you need 7 years of data and information and proof and, basically treating just growing the business in that way. So there's a lot of barriers to entry and it is challenging, especially if you don't come from the business itself.
Absolutely. Now, you've obviously had an incredible amount of success over the last, 16, 17 years, as you mentioned. When you look back over that time frame, do you have a failure or two that stick out to you as a real significant learning lesson, or something that changed your approach to the business that you'd feel comfortable sharing?
Yeah, certainly. I'm trying to think which one. I mean, look, it's really funny when you think about a failure at the moment in time. It seems awful. Um, but they're always learning lessons,
Hmm.
especially as you start managing more and more money. But I would say that even pre-Origin, like some of the reasons why I started with Origin was I had invested with some institutions. I'm not going to name names, but they ended up just it was mind blowing how quickly they lost my money, right, in those things. And you're just like, what just happened? I mean, the capital call was last month, and I'm getting a write down this month, and so and then investing with younger sponsors as well, in experience, when all of a sudden a year later you're in court with them and things like that. So yes, I've had some of those. Interestingly enough, though, we've only lost money on one deal at Origin, and it was an office deal. It was in one of our old funds. And here's what I would say: there's a difference between making a good decision and having a bad outcome versus making a bad decision and having a bad outcome. And what we try to do always is make good decisions and educate our investors. I can't control everything in this world. But what's really dangerous is when you see a market like we've had the last 4 or 5 years, and you get bad decisions leading to good outcomes, because it gets people way overconfident and doing some really, really stupid things because they start thinking that they're smart and they can't get hurt and they know what's going on. So we control what we can control. Look, the office deal, it got caught up in COVID. Was it the right decision? Was it the right market? Was it yeah, in high, I'm not sure that we would have done too many things different there. There was a deal, if we go back to one of our first funds, this goes back to 2010. We bought a student housing deal at Florida State, and I'll never forget that. But we were with this partner who, there was just something off the whole time, but the deal was so good and we were justifying it and this and that. We ended up closing on the deal. Well, lo and behold, things just blew up in the partnership, and we ended up exercising our right to sell and sold it at a small gain. But small gain when you're putting money out in 2010, that may as well have been a loss, because anything you bought back then was like a 3x. So I think we made like a 1.1x multiple. And look, we're always, there's always things that we're learning on a day-to-day basis, working with people, putting out little fires around it, fine-tuning our organization as well, making sure that we're not making any mistakes today that we've already made in the past as an organization as well. So it's a great question. And some of these are just embedded in my head. Some of them are with the team. We do try to document a lot of these things and have continuous education within our organization. We actually built something internally called Origin University. That's for, right now it's for internal purposes, but it's for the whole team to learn, to share stories. And it's been incredibly effective.
No, that's really interesting, because it's one of the most important things you can do is invest in the education of your team, obviously, right? And whether it's related to past lessons, failures, wins, successes, what have you, and how that relates to the business and how it's operating today. We have we haven't branded it something as catchy as you have, right? Origin University. That certainly is memorable. But it's funny, in our business, we have a catalog of in our deals, everything that went right, everything that went wrong, and if we can tie it back to a decision we made, right, or if it was something that we can define as out of our control, because I think it's a very important distinction you made, that sometimes good decisions still lead to bad outcomes. But I think people have been trained over the last 3-4 years that any decision leads to a good outcome. Doesn't matter what decision you made, it's probably turned out okay, unless you really went awry somewhere, assuming that you bought multifamily in a good area. It's hard to miss. But
yeah, and Axel, while you're on that, somebody actually just sent me this recently, and I'll forward it to you. But it's by I think it's Harlan Crow from Trammell Crow.
Mm-hmm.
And I think it's from the 1980s, but it was written on paper, handwritten, and it was the lessons of their entire team after they went through one of these downturns. And he said to the whole team, I want you guys to write down every lesson that you learned, because we need to be able to look back on this. And somebody forwarded it to me, and I thought it was so cool to read, because you see the same mistakes over and over and over. It's just a different year, but it's the same things that drive behavior.
100%. I mean, you could probably tie it back to like lack of discipline, fear of missing out, greed of some kind, and it's like just permutates from one of those, pillars of decision making that oftentimes puts us in tricky spots when everything's going crazy and we get caught up in it. Which it's hard to not put yourself in that position, but a document like that certainly helps you lend perspective. That is really interesting. I'd love to look at that, because we're doing that at a junior varsity level, but having somebody as experienced as him. The fact that that's a document that exists is pretty incredible. But anyways, Mike, yeah, absolutely. But we're coming up on a time. I want to make sure I get you out of here, and feel free to share anywhere that you'd recommend listeners go to learn more about Origin, maybe connect with you, learn more about the things that you guys have going on right now.
Sure. OriginInvestments.com. That's our website. We make it super easy for anyone to really interact with us. So we've got, you can download our decks. You can connect with somebody in our investor relations department. Just investor relations at origininvestments.com. You can email that as well. So thanks.
Awesome. Well, this was great, Michael. I appreciate the time.
Thank you, Axel. Appreciate you having me on.
Thank you for listening to this episode on the Multifamily Wealth Podcast. If you learned something new during the show, please consider sharing this episode with a friend, family member, or business partner, or just leaving a rating and review, as it helps the show get noticed by more folks. Catch you next week.